Hello and welcome to my channel, The Right Foundation, where bookkeeping for small businesses starts with smart books. Today, I am briefly going to talk about income statements. The title alone indicates that this is a very important topic because a business heavily relies on income to maintain operations and to gain profit. An income statement, also called a profit and loss statement or a P&L, is one of the main financial statements businesses use to measure their performance over a specific period of time, such as month, quarter, or year. An income statement report shows three important categories: the revenue, the expenses, and the net income. So let's talk about what each category mean. Number one, the revenue. Sales and income, which is part of the revenue, is money that is earned from selling goods or services. Number two is the expenses, and they are the cost of running the business, like rent, salaries, supplies, depreciation, and so many other things. Number three, net income. Now, net income can be the profit or it can be a loss. It is the difference between revenues and expenses. If revenues are higher, then the business will show a profit. But if expenses are higher, it will show a loss, which is not a good thing. That is why it is so important to keep track of your cash management every month, day, or do it on a regular basis as much as you possibly can. I also discussed cash management in my last video, so if you haven't watched it yet, I advise you to please take a look. So moving right along, a business uses an income statement to measure profitability in order to see if they are making money or if they are losing money. The income statement is also used for decision making by identifying where costs are too high or revenues are too low. Another important reason for an income statement is to track the performance of the business by comparing results over different periods, like the month to month or year to year. For example, you can compare what happened last month to maybe what is happening this month, or what happened several months ago to what is happening currently. Or you can also compare year to year. Maybe what happened in 2023 compared to what happened in 2024, and to maybe plan for what to come in 2025. Now, the income statement is also necessary for budgeting and forecasting to plan for the future based on past performance. The income statement is a great report for investors, lenders, and partners to review to determine the financial health of the business. Kind of like your credit score. Lenders look at your credit score to make sure you are reliable. And this is the same as the income statement, where lenders or investment may want to take a look at your income statement to see what you were doing in the past. Okay? Businesses use net income on the income statement to also calculate income taxes that are owed, which is important responsibility for a business, because you do not want to lack on your taxes. No, you don't. An income statement tells the story of how a business earned money and how much it spent, helping the owners, managers, and outsider to understand whether the company is financially healthy. It is important to periodically view the income statement monthly, like I said, or quarterly or annually, because it helps business owners and managers stay on top of the company financial health rather than waiting until the end of the year. It is never a good habit to wait at the last minute. You don't want to do that. Periodic reviews of the income statement act like a financial health check, because just like you wouldn't wait years to see the doctor, businesses should not wait until year end to see if they are healthy financially. I hope this information was helpful in managing your business. And if you have any questions, please leave them below. And last but not least, don't forget to subscribe if you haven't already done so. Also, like and share. Thanks so much for tuning in, and by the grace of God, I will see you on the next video. Thank you, and bye-bye.